In this episode of Do You Understand Graphs, Mr. Salomon kicks off his sandals. Didn't expect me to catch that, did you? So here's what's happening. Loanable funds. Not a big deal. Also very achievable. Again, we'll pause the video and see if we can test your might, if you will. What's happening is this. I'd like you to draw loanable funds 4 times and then present the following scenarios. Depict loanable funds crowding out. That means the government deficit spends. They spends money. They spend money they don't have, which is exactly what we're doing right now. Probably a very good idea. I know it's kind of indebting the future and blah, blah, blah. That's scary. But if we didn't do that, then, oh boy. So we do need to deficit spend right now as a country. And so it's extremely relevant. Depict crowding out. 2 ways to do it, don't forget. Also, capital inflow. That means money's coming into the country from other places. Investor tax credit. So the government passes a tax credit. That means you're paying less taxes if you build capital stock. And then finally, what happens to the loanable funds market when we're afraid of a pandemic? Pause the video now and enjoy. And I present, without further ado, the answer, which is not super surprising, I guess, for those of you who are loanable funds market enthusiasts. Remember, this graph is literally just depicting money in banks. The supply line is literally savings of money in banks available for lending out. That would be based on the reserve ratio, as you may recall from a future or past unit, depending on your situation related to time travel. The demand for loanable funds is just whether or not you want to take out a loan. So that's kind of the extent of what it actually means. So in a crowding out scenario, the government is spending money they don't have. They have to approach banks for money. If you're wondering, my sandals are back on, sidebar. So if they're taking all the money out of banks, there's no money available for other people, which is why it's called crowding out. Imagine the government as an actor, literally removing the money from banks, taking up all that space. They would remove the supply. You could also draw shifting demand to the right. Both would be correct. When the government crowds out, they reduce the supply of loanable funds, thus driving real interest rates up, making it more difficult for other people to take out loans, reducing capital accumulation, capital stock. Never forget those phrases. Capital stock, extremely important on the exam. That would reduce. Over here, capital inflow. If investors from other countries are sending money to the U.S., because they perceive our market as extremely stable, then the supply of loanable funds would increase because that money would come into our banks, our savings would rise, that would drop real interest rates and increase capital accumulation. It would make investments in bonds worse, if real interest rates are dropping, bond prices are rising. Remember that inverse relationship, so kind of a weird scenario there. But you get the gist. Over here, if the federal government passes a policy which is an investment tax credit, so reducing taxes on companies or individuals which actually build capital stock, if you buy a solar panel, you pay less in taxes that year. That would cause the demand for loanable funds to rise because I need to take out a loan to buy that additional capital stock, to buy that solar panel, to build that factory, a mortgage on that house. You get the gist. Finally, fear of pandemic. There are a couple ways to draw this. I think the easiest one is if everyone's afraid that the economy is like crashing and burning, then clearly we're not taking out loans to build new businesses. We're feeling risk averse is the fancy phrase. So the demand for loanable funds falls, dropping real interest rates, which is kind of handy because that would actually spur capital accumulation. It would cause it in the future, but right now it would drop, obviously. So you get the gist. Cool. Hope you guys have a wonderful day and, and loanable funds. Real interest rates, quantity, supply, demand. Does it get better, I ask you? Wait to find out more.